Good morning and welcome to Forecast 2022. I'm Janet Kane, CEO for the MetroTex Association of Realtors, and I want to thank you so much for joining us today. We all hear the constant changes that are going on in the news on a daily basis, so I look forward to hearing the insights of our speakers today and the future of the real estate market and the upcoming trends in DFW as we continue to navigate through these times. Today's webinar technology is being managed by Professional Development Program Manager Elizabeth Marshall, and Professional Development Director Roxy Glenn will be monitoring the chat. As attendees, you are muted to avoid background noise, so be sure to put your questions into the chat box so that we can be sure to get your questions addressed. I'd like to take a moment to thank and acknowledge our sponsor for today. Thank you to Republic Title for sponsoring today's event. Without our sponsors, these tremendous programs would not be possible, so thank you to them. I'd now like to introduce you today, today's moderator, Marion Napoleon. Marion is the broker owner of Unlimited Realty Solutions and has more than 20 years of experience. She's an active member of several boards and associations, including MetroTex, Texas Real Estate Teachers Association, Texas Real Estate Commission's Education Standards Advisory Committee, the National Association of Professional Women, and the National Minority Supplier Development Council. So please help me in welcoming my friend, Marion Napoleon. Marion?
Thank you so much, Janet, and welcome everyone. I would like to introduce our very first speaker for the day, Dr. Gaines, and you guys will absolutely love Dr. Gaines, and let's find out a little bit about him. Dr. Gaines has been with the Real Estate Center since 2005 and has served as the Chief Economist since 2015. Dr. Gaines focuses on the Texas economy as well as housing and land development issues throughout the state. Dr. Gaines has more than 40 years experience in a broad array of professional real estate activities in consulting, research, education, urban economics, land use and analysis, and development and project risk assessment. Dr. Gaines was an associate professor of real estate and finance at the University of South Carolina before serving as president of Rice Center, an urban research center affiliated with Rice University. Dr. Gaines provided extensive real estate consulting services to numerous businesses, financial institutions, developers, and all levels of government organizations during his tenure with Arthur Andersen and KPMG. Dr. Gaines earned his BBA, MBA, and his PhD degrees at the University of Georgia. You all will be entertained. Welcome, Dr. Gaines.
Oh, yeah. Thank you, Marion. I appreciate it very much. Let me see if we can get through the technology here, and we'll make sure that this is coming up correctly. I hope that everybody can see the slide there, the lead slide with MetroTex on it. It's showing on my screen, so I'm going to assume that it's coming up for everybody else. I do appreciate it. This is, I don't know, it's about the 7th or 8th year in a row, I think, that I've had the honor of leading off this program and talking about the future and doing forecasts. I've got to precede this whole presentation by telling you that for the last year and a half, with the pandemic and everything that's going on, there really isn't an economist in the world that really knows what the heck they're saying when they try to do a forecast. Because we've never had any situation like this before in our history, where we've had more or less a mandatory shutdown and had to close down, everybody shelter in place and go home and don't do anything and don't go anywhere and so forth. And then trying to pick it all up afterwards has been quite interesting. So it takes a little bit of doing. So take it for what it's worth. I'm going to show you what I think is going to happen for the rest of this year and talk about 2022 a little bit. And it's really kind of murky, so we'll have to see, because there's so many things going on, pro and con, positive, little bit of negative here and there, and so on. here's what's kind of going on now and what we're looking at in coming. And when we talk about the economy, or when I'm talking about economic recovery, talking mainly about getting people back to work and getting employment back up to pre-COVID and pre-pandemic levels in terms of number of people working and the income that they're making and their consumption, the spending of money, which is what really makes the whole economy churn and turn in the first place, is all of us going out and it's our patriotic duty to go and spend 110% of what we make so that we create GDP and create economic activity and so forth. So jobs and income, consumption, and consumption read GDP, if you will, if you want to, and economic. The whole thing right now hinges on getting the COVID under control. Now, last summer, we thought we were in this past summer, excuse me, 2021, June, July, going in, and I've got graphs and charts coming later that I'll show you to reinforce what I'm saying. We thought we were getting the COVID under control, and then we had this thing called the Delta variant come along that returned the whole thing. And of course, at the beginning of the year in February, we started having vaccines. We actually got drugs approved from the FDA, and people started getting vaccinated, and that seemed to have a lot of impact. And that was why by June and July, the number of cases, the number of deaths, the number of hospitalizations were trending well down, way down, almost to pre-pandemic levels. And then it picked back up again because we didn't quite do it enough to get that herd or group immunity going and so forth. Anyway, we're seeing whether or not we're going to be able to alleviate the impacts and go from there. We've had the federal government come in with major fiscal stimulus payments. Well over $3 trillion has been pumped into the economy, direct payments to people with stimulus payments, direct increases in unemployment, insurance compensation, the extra $600 a week or the extra $300 a week, which incidentally all gave out yesterday, or at least theoretically all gave out yesterday, unless something else happens. So now we're in that boat where a lot of people for the last year or so were probably making more money, particularly the hourly wage, lower income folks were making just as much or more money by not working as by working. That may now be slowly evolving and disappearing, and we'll have to see what that impact's going to have. Increase in consumption, latest numbers just came out yesterday, actually, and this morning. Personal consumption is back up. Inflation is back up. That's that last bullet point there. The inflationary pressures are going to be major. The Fed is still maintaining low interest rates as best as it can. First, by not moving the federal funds rate, although that's the least of the things that they're doing. That's the buying and selling, the buying primarily, of U.S. Treasury bonds and mortgage-backed securities. The Fed is still the major support going on for the housing market right now by being the major buyer of mortgage-backed securities from Freddie Mac, Fannie Mae, Ginnie Mae, and even other major suppliers there in the mortgage security market. How long that's going to last and how long the Fed is going to exercise that quantitative easing, which is just an extension of that quantitative easing that we all heard about 10 years ago. That's going to be the real measure on what interest rates do. And then, of course, we're running into this issue that's becoming more and more prevalent of the supply chain. Now, supply chain means the movement of goods, particularly from one place to another. Now, that could be imports and exports globally. And if you're not keeping up with it, we've got ships sitting out on the bay and out in the Gulf of Mexico and out in the Pacific Ocean trying to get into LA and elsewhere and around in Florida, trying to get into Miami and the ports on the Florida coast. They can't unload, and they're really backlogged. And then even domestically, we've got trucking and logistic problems that's slowing down and keeping things from moving. And then the manufacturing process coming in. So we've got this major supply chain problem. Here's what it looks like for those of you who like GDP as your measure of economic activity. And incidentally, also for those of you with literary backgrounds, whether it be in English or something else, 2020 was the best of times, the worst of times in terms of changes, annualized quarterly change in GDP. We had the second quarter of 2020 was the worst on record. That's that negative 31.4 you see there, followed in the third quarter by the best on record of 33.4 up. Now, the problem is, for those of you who are really into the statistics and arithmetic, what you'll immediately recognize, if you go down 30%, but come up 30% from that low point, from that down point, you don't offset, you don't come back to zero. So we really haven't made it yet. I can also tell you that entering the year on a forecast basis, we were entering 2021 with the expectation that we'd probably see about a 7.5 to 8.5%, somewhere in that range, positive increase in GDP, because we figured as we got through the pandemic and the economy came back up, statistically it was going to look a whole lot better because it was going to be compared 2021 compared to 2020. Well, 2020 was so bad that anything was going to look good. I got to tell you, the Delta variant, one of the impacts we're seeing is that now the general level of expectations among economists around the country is that we'll probably see between 6.5 and 7.5. It's been lowered 100 basis points or 1 full percentage point because of the Delta variant and things going on in the economy. You can see what the fourth quarter, first 2 quarters look like here for the year. The third quarter is going to be problematic. So somewhere in that 6.5 to 7% positive growth of GDP is about what we're gonna. Is probably what we're gonna. Here's statistically and the picture of what I was trying to describe. You can see how back late fall of last year on into the winter and into January, we peaked in terms of number of cases. The red line is a 7-day or it's a weekly moving average on the daily cases, and you can see, but then we started the vaccine program. We started that in February, and that was the big decline going down through into June. And then in July, about mid-July, the Delta variant started hitting the nation, and it's the increase in the rate of daily cases and hospitalizations and the death rate, all of them paralleled this same line. All of it started coming back. Now, the only good news I've got for you is that what you can see is right at the tail end of that red line, it has, this is and some of you have heard me speak before, this is a hump over. It's when the trend line was going up and up and up, and then it turns and comes and turns back down. I term that a hump over. That's just my personal term. We can make it a technical term if you'd like. But nevertheless, the good news is, it looks like the Delta variant impact, or at least in terms of number of reported cases and so forth, has peaked and is now downturned and coming down. And we were discussing here just before we got started this morning's announcement from Merck that they're developing a pill to help address the symptoms and the illness should you get it. And then the vaccine program, if we do the booster shots or whatever, or if we just keep increasing the number of vaccinated people, hopefully that's going to get that trend line back down to what it looks like back over on the very far left. If you see the horizontal line back to January of 2020, that's what we'd like that line to look like. That's pre-pandemic levels, and we got to get to there before we'll have absolute true recovery and everything. Here, like I said, we're looking at recovery and employment. You can see nationally the big dip there, if you will, that was in April of 20. We lost over 20 million jobs. People were laid off. Unemployment spiked. And then we bounced back fairly well, about 50% very quickly within the matter of a couple of months. But then since then, employment growth has been consistent, but it's also been a lot slower. We're still down about 5 million plus jobs, about 3.5%, just to get back to where we were in February of 2020, where we had 152.5 million people working. We've now got about 147 plus million people working, and it's going to take a little while longer before we just kind of get back up to where we were. One of the ironic things that's going on, though, is the people, jobs are opening back up. Employers are desperately seeking labor. They are still looking for people to come to work. If any of you have gone to and stayed in a hotel lately, if you've gone to a restaurant, or even to other service type businesses or goods businesses, retailers are still looking for employees to come in, Walmart and so forth. I mean, and they've increased wages up to $15 an hour and all kinds of things, not just them, but Target and other major retailers. They're still desperately seeking out new employees. We've got officially about a little over almost 8.5 million people unemployed and almost 11 million jobs available. So when we hear these things about, I can't get a job, well, that's not really true. Now, we do have a problem in matching job skills, labor skills with the job openings and those kinds of things. And also now as the expiration of the additional unemployment benefits are coming to a close, we may see people now a little more willing to come in. Here's one of the big worries going forward. Inflation, of course, has jumped way up. CPI is well up over almost 5.5%. Core CPI, if you net out energy and food, and that's supposed to be basic cost of goods and services, is now still over 4%. The general wisdom going right now is that that's going to be temporary. It was expected because prices had dipped so low last year. We expect prices to go up. We don't know how long that's going to last. And that's one of the $64 questions. I think it'll last, though, going into 2022. I think you're going to expect to see high rates of inflation at least the first 2 quarters of the year in terms of the first half of the year. And it may prevail on into the second half of the year, particularly with the supply chain disruptions that are going on that is limiting the supply of all kinds of items and goods. And in the housing market, we know it's affecting the cost of building a new home because of lumber prices and steel prices and concrete prices. Getting windows right now, ask a builder if you can get windows, if you can get them at all, and then if you can get them in a timely fashion and what they're costing. Doors, prefabricated issues, LED lighting, all kinds of items just within the home construction industry, not to mention general merchandise. So we're going to see that supply disruption. We're going to see wage push as wages are going to go up. If employers are forced to have to pay higher wages for employees, then we're going to see that come along. So it's going to be interesting. It may not be quite as temporary. And if that holds up, it also means what it's going to mean is that these interest rates are going to change. Right now, we can see the federal funds rate, which is the green line there across the bottom, is still hovering basically effectively at zero. It's technically at 0.25 in terms of the range the Fed has set, but they have indicated so far, they just met about a week ago, a week and a half ago, that they're not going to change that rate anytime soon. Like I say, though, they have announced that they are going to start tapering off their purchases of treasuries and mortgage-backed securities, probably starting in the next couple of 3 months. But that was not a full-fledged promise, so we'll have to wait and see what's going on. The 10-year treasury is hovering right about 1.5% right now. The 30-year fixed mortgage rate is right around 3%. In fact, technically, it's a little bit less than 3%. I'm sure all of you could tell us anecdotally of what's going on with some of your clients and your buyers getting loans for even under 3, particularly if they're going for 15 years and they got good credit ratings, down payments, and so on. The good news here is, though, the lenders have not just opened the floodgates and just made loans available to anybody and everybody who walks in the door, like we did back in 2005, 6, and 7, that led to the Great Recession of that time and the collapse in the housing market. That's the good news. The other good news is that with prices going up so fast, there's more equity in the market right now to give us some protection, some buoyancy on the forbearance programs that are also now going to give out. And now some of the people who have perhaps not made a mortgage payment in months because of the COVID and were allowed to do that are now going to either have to rework their loans, refinance, do something else, or face the prospects of foreclosures. We're probably going to see a little jump in foreclosures. There's no avoiding it. The issue is going to be how many. Back in 2008-9, we had like almost 12 million foreclosures nationally. Right now, the general estimate is there's about 1.5 million loans in forbearance. And even if a half of those, and that would be a high percentage, wound up in foreclosure, it would be, less than 1 million, about 750,000. And the market can probably absorb that and not be affected nearly to the extent that it was back in that 2008, 2009 time period. Consumers, like I said, people spending money is very critical. So we look at confidence indexes and confidence measures that consumers have. What we've seen is here in the last month or two is a pretty good drop off in consumer confidence because of the Delta variant. If that continues to dampen optimism and people withdraw from spending money, then we're going to have some. It's going to delay the whole overall economic recovery and be a possible precursor to a recession. Incidentally, technically, the National Bureau of Economic Research declared last March and April to be a 2-month-long recession. It's kind of a silly thing to do, but nevertheless, they did it. And because recessions generally are longer-term kinds of things, as well as growth periods. So that's the 2 months that you see the big dip there in the consumer confidence. CEOs, big corporations are still fairly confident of coming back out. This is through the second quarter of this year. This is a quarterly index. And of course, we don't have the third quarter numbers out yet. So my guess is going to be that's going to drop off some, but it'll still be reasonably good. That big companies, the profitability is still up. Profits are still up. So the big Fortune 500, Fortune 1000 companies are still fairly optimistic. Small businesses, the less than 500 employees, technical definition of small business here by the National Federation of Independent Businesses, their overall optimism index, you can see, has dropped off in the last month or so. It peaked last October after we were, as we were going into the season, and we could see on the horizon the vaccines coming and things were loosening up a little bit. Just before and then it fell off when the COVID peaked in the early part of 2021, and then picked back up, of course, as we move forward. So all of these things taken collectively, it looks like nationally we're on the road to recovery. Is the best we can say. It's going to be a little bit of a slower road and a slower ride down the road than what we originally anticipated. But it's still more positives than negatives. We're going to hit some road bumps. I think we're going to get through the Delta variant. Maybe one of the big unknowns is if there's going to be a Gamma variant or a Gamma variant, Lambda variant or something, some other Greek letter. We'll have to see if that's ever going to happen. But it looks like we're going to get that pretty much taken care of. And if we do, and we get it back under control, or what we think is under control, we'll be going forward in pretty good style. Let's focus on Texas. Texas had a double whammy. In December of 2019 and January 2020, the Saudi Arabians, the Saudis, and the Russians decided to have a oil price war among themselves. And of course, that meant there was a global price war. And that started the first round of downturn for Texas because, of course, our energy industry got picked up in that. The price of oil declined considerably. And so we felt the initial impacts. Now, the interesting thing is Texas is becoming less and less energy dependent as a state, our state's economy, and it tends to be a more localized kinds of impact. So we know Midland, Odessa got affected the most. Houston got affected. Beaumont, Port Arthur, Victoria, Corpus to some extent. Some of the areas in the Barnett Shale play earlier up in the Fort Worth area, but that had already played out. The Eagleford area, which of course is just in between Corpus and San Antonio. So we didn't get the kind of impact from that energy decline that we'd had in the past come through. And then, of course, in March and April and May of last year, then the pandemic hit, and that was the real whammy that we got hit with. Then our recovery in Texas, really, we've been outpacing the U.S. We can see that, again, everything is still COVID control dependent. But here's what's happening. It's still going to take all the rest of this year at least. Now, I've got some good numbers for you coming up in just a little bit, that it looks like by the end of this year on an annual basis, we should be back pretty close to where we were, if not slightly ahead of where we were in 2019. 2020, of course, down year, recession year, if you want to call it that, and not just the 2 months, but really almost the whole year. But it's going to take all the rest of this year and maybe on into the first quarter of 2022. And that's that variable of getting the Delta variant under control. Job recovery is active, still a little sluggish, but we are adding jobs every month and we're doing better. Consumers are spending. One of the factors we're looking for in Texas is entrepreneurism. We've lost something like 85,000 plus businesses in the state here that have simply disappeared. They're probably have just simply had to close the doors and are going to have a great deal of difficulty reopening. And that these are businesses, all walks of life. Restaurants are the most obvious. Daycare centers have had trouble. All kinds of other kinds of personal services, businesses, and so forth that are not going to make it. But Texas has always been an entrepreneurial state. We've had that ability. We have relatively low regulatory entry barriers. So it's pretty easy to get into business in Texas. And we're looking forward to maybe replacing or repairing all of these lost businesses with new ones, with new entrepreneurs, or even the owners of the old business, if they can gather the capital. And there, our banking system is going to be critical for funding some of these new businesses. Energy is not likely to be a driver of our economy for the next couple of years. We don't expect it to be. Its relative contribution to our state's economy and to employment in particular is declining. It's leveling out is what it's doing. It's not going to go away. It's still going to be a major industry, but it's not going to be the major player that it's been. We're expecting energy to be more or less neutral. Maybe even slightly to the positive side here in the next year or two as the price of oil does start picking back up, and it has picked back up. So slightly positive, but not the big driver. Housing is the strongest market nationally. It's the strongest industrial segment in our state so far, but it's not having the same pull through or pull up effect that historically housing has generally helped lift the whole economy up out of recessions in the past. It's not having that same pull-up effect here lately, and that's kind of surprising. It's helping. It's obviously positive, but it's not as big a positive as what we might have affected. Population growth is still coming. I know you're all looking around, and you still, despite the fact that people haven't all gone back to work yet, you're still getting traffic jams and having a long time in traffic and so on. Here's what Texas looks like on the COVID. You can see the Delta variant was hit Texas very hard. We bounced back almost to the same total level of impact as we did last winter. But we've had a fairly sharp drop off in the last several weeks. We hope that is an indicator that is going to continue to drop and not have a bounce back up effect. but it is having a very significant impact on the health. I know in some communities now, ICU beds in the hospitals simply don't exist. A lot of the elective surgeries and so forth are being put off and so forth. Healthcare services are being stressed or stretched to stress points. So we're having to see how that's going to all work out as we go forward. In similar fashion, though, we're a little bit doing a little better than the U.S. We're about 97.6% recovered, if you want to use a statistic, at least through August. We're still down about 330,000 employees, people working to get back to where we were in February of 2020. You can see it's been erratic a little bit here in the last 8-9 months, but we're beginning to come back on a better trajectory. And I can tell you that our outlook right now is that by the end of the year, that's me knocking on wood. That's a technical economics thing that we do from time to time in trying to make a forecast. But if we can attain about a 6% job growth, which we are currently at or near that statistical level, then we should come up pretty close to about 13 million jobs, as you see here on the graphic, by the end of this year, which would be better than we were in 2019. Again, 2020 being the down year doesn't count. And to get us back to where we'd like, more close to where we'd like to be. Here's the energy industry I was talking about. And in fact, on the daily level, that West Texas Intermediate crude dollars per barrel is right now closer to 75. These are weekly numbers. It's much closer to 75 than 70. It continues to go up and stay up. What isn't going up as dramatically is new rig count. And of course, that's where the upstream jobs are. We simply are technologically, the wells being drilled are far more productive than the wells that were being drilled just 4 or 5 years ago, and by magnitudes, incidentally, not just a little bit, but by a lot. So we simply don't need as many wells. And the global demand has not come back for oil because globally, the recovery from the pandemic is going actually slower than it is in US and Texas. So that global demand for oil is still very sluggish, keeping the need for additional supply of oil pretty much constrained. So we're just not seeing the same rate of increase in the number of rigs being drilled that one would have expected. That's the reason for the big gap here between the price and the rig count going so wide and disparate. It'll be interesting to see if and when that changes as we go forward. Let's talk a little bit more about Dallas-Fort Worth MSA. If you haven't seen the number, the 2020 census came out. It's a little over 7.6 million people. Fourth biggest, largest MSA metropolitan area in the country. And it compares to around 6.4 million that was counted in 2010. So, and almost about 10,000. Some of you might like to have this is my trivia for the morning, the 9,278 square miles collectively in all of these counties. So it kind of gives you an idea. So when I'm talking about Dallas-Fort Worth MSA, this is the area I'm talking about. A little later on, I'm going to talk about the Dallas-Plano-Irving, and what it is the eastern part of this area, Denton, Collin, Hunt, Dallas, Ellis counties, and east, constituting the DPI, the Dallas-Plano-Irving Municipal Division. Here's again, similar graph for the DFW area, MSA daily new cases being reported. This is, again, you see the similar pattern decline from the previous high back in the winter of 2020 and then January, February, in through June, into July, big drop off. If we could have maintained that level of new cases, the recovery would have been a lot faster and a lot stronger. Then the Delta variant hitting in July and bouncing everything back up in terms of new cases. And incidentally, the hospitalization rate, the death rate follows the same trend line that we're looking at here. Now, again, the good news, if you look right out toward the end of that blue, solid blue line, you'll see it's showing that tail off or trend downward, and we're looking forward to that trend continuing on. In terms of building permits, it's interesting in Dallas-Fort Worth, we're seeing tremendous construction in the housing market. We're going to see, it's interesting, it's about a 16-year cycle from 2005 out to 2021 to go from from prior peak to creating a new peak. When it was about 17 years when we recovered from the 1980 decline. So it's kind of interesting that we're seeing a first half of a similar pattern in terms of the cycles for new construction. We're looking for new construction to be up over 22%. Non-farm employment in the Dallas-Fort Worth MSA, you can see a similar kind of thing. About 97% recovered, about 3% short. March and April lost a lot. We're still about a few thousand jobs down. Through June, we're looking for annual jobs, though, to come back about 4% and be about equal to that 2019 number. The annual numbers are a little easier to deal with than the monthly, because monthly changes. So we'll have to see how that goes. Let's turn our attention then for the next few minutes to the housing market. It's been reported, and many of you are hearing the reports, that the housing market is losing some steam. It does appear that there is going to be, there is now something of a slowdown in the rate of sales going on, and that's what the steam is in the rate of sales. A lot of that, though, we'll see how it plays out. Here are the main factors that are playing out in the housing market today. First of all, and I know that I think Steve is going to talk a little bit more about the demographics, but we can't ignore it. First of all, the population of Dallas-Fort Worth is still going to increase. People are still moving to Dallas-Fort Worth, and the natural increase in births over deaths is increasing it particularly. But into the housing market, we've got the demographics of the millennials. And here I'm talking about 20, 30 somethings, not trying to be too technical about it, but especially the 26 to 40-year-olds right now. One of the things the millennials have discovered, and many of you listening in may be in this age group, but one of the things you're discovering, to your chagrin, because there's nothing you can do about it, and that is that you're getting older. And as people old and they move through the life cycle, of eventually living together, getting married, having children, so forth, they get into the housing market. So we're seeing that. I'm sure a lot of your clients are in this 26 to 40-year-old age group. At the same time, the Gen Xers and the boomers are still being active, particularly the baby boomers. Those of us, and I'm a boomer, I'm on the front end of the boomers, but those of us that are moving, we are sometimes looking to move down. We might be moving one way or the other. It's interesting, this debate about are more people moving to the suburbs than to the urban centers and so forth. And yes, statistically, there's probably a greater movement to the suburbs, more for looking for lower prices and space than are moving to urban centers. But the demographic groups here that we're talking about are large enough that there are significant numbers moving in both directions at the same time. So we are seeing increase in housing demand in the urban centers, and simultaneously we're seeing increased demand for housing and ownership housing in the suburbs, and it's happening. It's not a either or, it's an and kind of an effect. The other is, of course, right now that you're all aware of is the limited inventory. One of the things that's happening is that so many of the boomers and Gen Xers are deciding not to sell. I just refinanced my house for 3%. I've been here. I can't find another house to move to, even if I wanted to, so I ain't going anywhere. Also, it took me 20 years to grow my kids and get rid of them. I don't want to go where they are. So we're looking for those kinds of effects. Affordability has become an issue, obviously. Price levels have gone up dramatically just in the last couple of years. I think that we are beginning to see the early signs, and perhaps you could tell me better than I can tell you, that we're seeing some sticker price shock. Price to income levels. Incomes have not increased as rapidly as home prices, and that is throwing everything a little bit out of whack. Or imbalance and affecting what's going on. Interest rates, though, of course, staying low, increases purchasing power. And as long as the ease of mortgage credit is not too tight, people can find the credit. Technology has changed the way you do business. It is now possible for people to buy properties online, sight unseen, never actually having to come face to face with anybody, with a realtor, with an appraiser, with an inspector, with the seller, with the buyer, with the title company, with anybody. Can all be done. And of course, that's increased the investment buying and investor buyer nationally, so that a fairly significant percentage of home sales right now are being registered by LLCs, LLPs, and other types of investment organizations, and they are affecting individual markets tremendously. So we'll have to see how those things go on. Let me go on to, all of a sudden it won't go forward. There we go. There we go. Here we are in Texas. I'm gonna hit some just high points real quick. What I want to point out, I'm comparing the second quarter of this year to the second quarter 2019. Second quarter of 2020 doesn't count. That was when we lost all the jobs. That was when the pandemic went into effect. So here I'm comparing. What you'll see is that in Texas, almost a third of the home sales in Texas in 2019, second quarter, almost a third were under 200,000. What you see in second quarter 2021, that's now less than 20%. Simultaneously, we only had about 10% of the market of sales in Texas were over 500,000, where today it's almost 19% of the market. So the distribution of sales has shifted toward the high end of the market, away from lower price. And of course, part of that is the inventory shortage, which you can see the active listings are down 42% from last year. Closed sales are up 25%. That was good. But we only have 1.4 months of inventory through the second quarter of this year. I got to tell you, in Aggie speak, since I'm from A&M, in Aggie speak, we just ain't got none. So we'll have to see how that's going. Here's our projections for the state. You can see that for Dallas-Fort Worth, we are looking for the sales pace to slow down a fair amount, although that may prove to be fairly too conservative, too low a number, because it's not showing there quite yet. But the real reason for the slowdown, the sales, is number one, the inventory. There just isn't enough product to sell, and number two, the sticker price, the price affordability issue. The price per square foot is still expected to go up close to 17%. And anytime that's double digits, that's a lot. What we're looking for is home sales in Texas will set another record. If we get a 5.5% increase in sales, you can just see that purple bar out there. It's a dramatic increase, well above anything else we've ever shown, and about 9 to 10% increase in prices. If you look at the sale price to list price ratio, this is telling us how strong the market is. And what you look at here is the red line and the green line. Red being the Dallas-Plano-Irving area, and the green line is the Fort Worth. And both of them are over 100%. Well, when you're averaging selling homes for more than 100% of the listing price, that means prices are being negotiated up from list price. You've got a very strong, very tight market. Similarly, this is our home price index. Rather than looking at averages and medians, we look at repeat sales. This is similar to the Case-Shiller index, the FHFA index, and other indexes. So you'll see that the index for Dallas and Fort Worth, well over 15%. Anytime that index over double digits, That's extremely, extremely high. Now, Austin obviously is off the chart, but Dallas, Fort Worth doing extremely well, both Dallas and Fort Worth. Building permits, similar to what I showed you a minute ago. In fact, here's the same graph. I'm not sure why it was in here twice. Sorry about that. You can see how we're expecting home construction to be very, very strong this year. Here's what some of the builders are doing to alleviate the boredom from COVID. They've added some extra amenities to the house. This is a optional amenity to a buyer if you've been cooped up too long and sheltered in place. Similarly, in Dallas Fort Worth, the 2019 to 2021 comparison, again, 20% less than 20% of the sales less than 200,000. Today, or second quarter of 2021, less than 9%, or right at 9%. And similarly, 12.5% of the homes sold in 2019 were over $500,000. Today, it's nearly 23% of total sales are over $500,000. That's the reason for, incidentally, why the averages and medians are showing such dramatic, the 22.2% increase in the median price. A lot of that is because of the distribution of sales as much as actual property values. Although I showed you the repeat sale index there that shows you that even at that, the repeat sales are even at that still up over 15%. So we're seeing active listings continue to fall. We just aren't getting the number of listings. New home construction is still limited. 1.2 months of inventory, you ain't got none. Monthly sales in the Dallas, Plano, Irving area, most recent sales. New home sales tend to be coming down. The home builders are having trouble getting the houses built. And so, quite frankly, we've talked to a number of builders who are telling us that they're actually not contracting new homes to be built because they're so backlogged with homes that they haven't started or completed from prior contracts. So it's interesting the way new home sales are counted. It's when the contract is signed. Existing home sales are counted when they close. So it's two different kinds of measurements, and that's the reason you're seeing that decline in the new home sale category. It's that the contracts being signed by the builders is declining. They're still building more houses, but now they're backlogged. They signed the contract months ago, and they're trying to get them closed or tried to get them completed and then closed. Here's what it looks like. This is year to date, and this supports what I was telling you just a minute ago. If we look at the year to date 2021 sales, and this pattern is going to continue. Very low inventory in that 200 to 300,000 price range, which is really one of the more popular price ranges in terms of buyer demand. But we see that percentage-wise, almost, what do we got? 67% almost of the sales, 2/3 are over 300,000. So 2 and 3 homes being sold in the Dallas, Plano, Irving area. This is the east part of the Metroplex, are selling for something over 200,000. And you can see the month's inventory, even for the 500,000 plus, is only 2 months inventory. That's remarkable. Normally, especially for the $1 million plus market, normally you would find anywhere from about 9 to 13, 14 months of inventory being sort of normal. And so 2 is just completely abnormal. We are still expecting total sales for the year to increase. Even at a 3%, I think I showed you 2.6 a minute ago, at a 3% rate, we'll still be higher than 2020, higher than 2019. Prices will be up about 15% and look something like this. And these are averages and medians. Single family permits in the Dallas, Plano area, very similar pattern. It's interesting. Again, we're seeing that 15, 16 year cycle. 2020, home construction was way up. It was up 26%. This year, so far, year to date, it's up 37%, which is in excess of the 20-something, 22% we were expecting for the year. So by the end of the year, if the builders can keep up the pace here, it's going to be an extraordinary year for new home construction going forward. And it's a very similar pattern that you can see that we experienced back recovering from the 1983s. I appreciate your attention. That's going to complete. You can hear me banging on the things here. Technology is wonderful until it doesn't work.
Thank you so much, Dr.
I
Gaines.
knew I had at least an end slide that would tell you, hey, I'm finished. You know, the best 2 words of any economist doing a presentation is, I'm done.
Thank you so much. Job well done. Guys, please help me thank Dr. Gaines for sharing so much information with us. We will now begin our Q&A, and if you have questions, you can put them in the question pan. But Dr. Gaines, I do have a few questions for you.
Sure.
The first one, do the new construction numbers include multi-units as well, or is it just single-family residence?
The data that I was just showing you is single family. So it did not include the multifamily. The multifamily market, the apartment market has done remarkably well. It was interesting, even with the eviction moratoriums and so forth, and now those are giving out and people are expecting some apartment units to go out. The apartment markets have held up pretty well, and particularly in the Dallas-Fort Worth market. And Dallas-Fort Worth, incidentally, if you're not aware of it, has been the leading multifamily construction market in the United States, metropolitan market in the United States, for the last several years. And what we're seeing is that this year, there's still going to be a fair number of apartments that are going to come online. Now, of course, the cycle for that is about 2 years to get a major apartment project built. So some of these were actually started before the pandemic. So we'll see those. The real question will be permitting. Multifamily permitting has been kind of level to slightly down a little bit, but I expect it to also continue to be fairly strong. The population growth, the need for housing, the need for apartment units in rent ranges that are affordable is still extremely strong in the Dallas-Fort Worth market, so we expect that to continue.
Awesome. Well, again, thank you, Dr. Gaines. You did such an amazing job that we do not have any more questions. Thank you so much.
Oh, well, thank you. My pleasure.
I would now like to introduce you to our next speaker. So you do have one, I think, here. I'm going to go ahead and ask it to you before I transition. It says, do you think the strong 500 plus market is due to, hold on a second, nothing just popped over. It's due to wealthy folks using their primary residence as an inflationary hedge? And how will this shift of funds affect the stock, bond, and other investment markets?
Well, those are good questions, and there's no doubt about it that buying a house in the last couple of years is going to prove out to be a really good inflationary hedge, because the value of homes has been going up more than almost 4 times the rate of inflation. So it is probably going to be a pretty good inflation hedge. Now, I've warned everybody who's asked me, is now a good time to buy a house? That was the question I thought was going to be asked. I've been telling people now is a good time to buy a house, and it's been a good time for the last year or so, as long as you plan to stay there for a while. Flipping I know there's a lot of flipping going on. There's the investment buyers who are trying to buy, and a lot of people who are buying and trying to turn it over. There, you've got to be pretty selective. You got to know what you're doing. But it is a good time for the owner-occupant that really wants to buy a home and occupy it and live in it for a while. It's going to be a pretty good inflation hedge. I think so, yes. The second part of the question was?
Let's get back to it. Hold on one second. Oh, hold on. It says the second part was using their primary residence as an inflationary hedge, and how will this shift of funds affect the stock, bond, and other investment markets?
Oh yeah. One of the clouds on the horizon is going to be the stock market and the wealth effect. Right now, for the past year or so, all of you are probably well aware that we've had a real bull market in the stock market, and people feel wealthier, even if they don't have money invested in the stock market. But most of us have 401ks or other forms of investment that one way or another, either through mutual funds or whatever, are in the stock market. And people, when they feel wealthy, they tend to spend money. They especially want to buy a house and maybe use that investment. Also, during the pandemic, during 2020, the personal savings rate, since you were stuck at home, you couldn't go anywhere, and other than Amazon or Walmart online or something like that, people weren't spending money. The savings rate went up close to 40% at one point. It's still hovering somewhere around the 10 to 12% mark, which is several percentage points higher than the long-term average or norm. So people do have some capital, they have some wealth. It's showing up in down payments for houses and so forth. So yeah, and I'm not an expert on the stock market. The best advice I can give you there is find out what I'm doing and do exactly the opposite.
Okay, awesome. I have a couple more and then we're going to move on. Do you have any concerns about the number of investors in the market?
Yeah, the investors are the ones trying to buy the properties at the premium price and then flip it and sell it, for a profit. Or they're buying the house and converting it into a rental unit. And of course, what that does is it takes the house off of the market or out of the market of being an owner-occupied house. So we are seeing that, and the Dallas area is seeing it. We're seeing even home builders in the Dallas. I think there's several communities being constructed now of rent-only homes rather than for sale. They're for rent by the builders. And the builders their exit strategy appears to be to sell the subdivision in toto to an investment holding company, be it a REIT or some other type of investment holding company. So that is affecting some of that inventory of for sale homes. So yeah, we're seeing that happen. It's so far it hasn't been a big enough share of the market to have a significant impact at this point.
Okay, awesome. Question says, a few years ago, Dr. Gaines said a jumbo jet full of people moved here daily. What is that number now?
I don't know, but I think Steve Brown's going to talk about that.
Okay, awesome. And one last question.
So is that a good way I can avoid it?
That's a great way to avoid it. When do you anticipate the next recession?
The next recession. There will be another recession. I'm a good economist. I'm going to tell you what's going to happen. Telling you when it's going to happen. That's a tough one. I mean, there are a number of economists who are projecting that it's possible that we'll see the next recession start sometime in 2022 or early 2023 at the latest. That's hinged on a number of things. What it'll be, in my opinion, it won't be one single thing that will happen. It will be a combination of 2 or 3 or 4 different things that all happen. Some might even be global effects. The immigration policies, labor issues, wage rates, the inflation rate that I mentioned a minute ago. I know we haven't mentioned it here yet this morning, but Congress yesterday passed a temporary bill to keep the U.S. government afloat through December, I think. Well, that's no way to run a major business. You don't run it on a month-to-month basis. The debt ceiling is an issue. It's going to have to be expanded. There really is no choice, but the politics are playing such havoc with the economy that it's going to, and I'm not being partisan here. It's both parties. It's everybody. I don't care what your politics are. There are certain things that have to happen. We've got these 2 bills that are now being compromised and debated on the infrastructure development versus the social programs. And both are on the surface, both are good things. I mean, they're things that would probably be in total good for the country, but they're costly. And the issue is not whether or not we need them, but just simply how do we pay for them? If we can figure that out, then it'll work. So when is the next recession that I finally get away from having to answer it?
You did a great job of getting away from it. Thank you so much again, Dr. Gaines. I would now like to introduce our new speaker. Peter Brodsky, owner and CEO of Reimagine RedBird Development, formerly known as Southwest Central Mall, and prior to that, it was called RedBird Mall. He is investing in the mall and its surrounding land to restore it to a place of pride and quality in the community. Prior to acquiring the mall, Peter was the founder and partner of HBC Investments, LLC. Prior to co-founding HBC, Mr. Brodsky was a partner at the private equity firm of HM Capital Partners and its predecessors, Hicks Muse, where he was employed for over 15 years. At HM Capital, Peter focused on the media industry and was responsible for deploying or managing over $2.6 billion of equity investments. In the civic and nonprofit arenas, Peter served on several boards. He's chairman of the City of Dallas's Animal Advisory Commission, as well as involved with the board of KIPP Texas, a network of 55 schools with 29,000 pre-K through 12 students in Austin, Dallas, Houston, and San Antonio, and the advisory board of KIPP Texas, Dallas, Fort Worth, a network of 7 schools serving over 3,000 students in grades K through 10 in Southern Dallas, which he chaired from January 2011 through June of 2017. Peter received a BA in Russian literature from Yale. Please help me welcome Peter Brodsky.
Well, thank you very much for that introduction, and thank you for the opportunity to address your group. I totally disobeyed the rules and did not send my slides over earlier, so hopefully there'll be no technical difficulties. There we go. Can everyone see that? Great. So I'm going to talk to you today about the RedBird development. I'm going to spend a little bit of time on the why, because that's really important. And then I'll give you an update. We've been at this for just over 6 years. Our 6-year anniversary was on September 18th, and huge amount of progress. So I'm going to dive right in. So the first thing I need to make very clear is that this is a for-profit investment. This is not a charitable or philanthropic effort. This is not done because our investor group wanted to, do something good in Southern Dallas. We do want to do something good in Southern Dallas, but the motive here is the motive that we all have when we make investments and when we go to work, and that is to earn money. And so the thesis that we've got here is really very, very simple. And it's that Southern Dallas is fundamentally misunderstood and it's underestimated. The images on the left are sort of a caricature, but unfortunately not too far off the way Southern Dallas is often portrayed in the media as a universally poor area of town with a lot of, drugs and crime, and basically an area to be avoided. And the pictures on the right are pictures of the actual Southern Dallas, which has some beautiful homes and has families and parks and people who want nice things. Now, the history of Dallas is such that Southern Dallas is a poorer part of town than North Dallas, but that's the result of some very intentional policies that were instituted and implemented to great effect over many decades of essentially starving the South for capital. And so we're living with the hangover of that right now. But despite that, there are still broad swaths of middle-class communities who want the same things that the middle-class communities in North Dallas want, but there are no amenities. Very, very, very limited amenities in Southern Dallas. And that's where the money-making opportunity comes in. Another perception versus reality is just what Southern Dallas is. Just by way of a vocabulary lesson, this part of this purple part of the slide is not South Dallas, it is Southern Dallas. And the difference is that South Dallas is a little neighborhood up here by Fair Park. It's a very specific neighborhood. It's about the size of Highland Park. Southern Dallas refers to the entire southern part of the city that is bordered by the Trinity River to the west and I-30 to the east. It is, it's a huge part of town. It's 208 square miles. It's very diverse racially, socioeconomically. It's got a beautiful topography, and yet it is constantly portrayed in a very narrow light. So the idea here is that we wanted to find a place to implement and invest on the thesis that this was a part of town that had economic viability, where there would be a demand for attractive amenities, and RedBird Mall was the perfect place to do it. It's located at the intersection of two major highways. It's got a huge amount of land, so there's something major you can do there. You can really change an entire environment, and it has a very important place in the consciousness of Southern Dallas, because it was long a place of quality where the community could go and receive the things and the amenities that they wanted to receive. It was very, very popular for about 25 years. It began to go downhill in the late 90s, particularly as people in the community began to move further south in search of better schools, particularly to Cedar Hill and Duncanville and DeSoto. The JCPenney and the Dillards at the mall moved down to Cedar Hill, and then it really began a long process of decline. It went from owner to owner to owner, and every owner just decided that they were going to milk it rather than invest in it. And that's what we're doing differently, is we are investing in the mall. Mall, however, cannot continue to be a mall because malls are dying all over the place. And so we are reimagining it into a mixed use development. So it's a terrific location. It's located at the intersection of 20 and 67. It is actually closer to downtown than the Galleria. So it's very convenient to downtown. It's convenient to DFW Airport. And it's got a really attractive audience with its proximity to the southern suburbs, in addition to Oak Cliff. There's a little more detail on that. It's got a very attractive median income. There are some terrific community assets around there, including mega churches and multiple colleges and universities, and then wide open for competition. We opened a Starbucks there in December of 2018. It is the only freestanding Starbucks south of I-30 in the city of Dallas. The other 3 or 4 of them are in kiosks. There's no movie theaters in the area. There's also very little office space in the area, very little medical in the area, very little Class A multifamily in the area. There are some beautiful homes. A lot of them need to be renovated, but there is a huge gap in amenities, but beautiful topography and houses with great bones on beautiful lots that you just can't get anywhere else in Dallas. And to show you the demand for these amenities, that Starbucks that opened in Dallas at our site in December of 18 is the number 3 Starbucks in the Metroplex now, number 3. So anyone who says that there isn't income in that area is simply misinformed. A big part of our development was developing a relationship with the community. This is a community that frankly has not been well treated by developers. I think developers come in and either impose their vision of what the community should want, or they don't consult with folks. This is a community that understands what that feels like. They don't like it, as no one would. And so we've made a really intentional effort to reach out to the community, get their input, and get guidance from them, and then bring them along. And so we've had a terrific relationship with the community. One of the biggest difficulties with the development was assembling the parcel. This is a map that shows the ownership of the parcel prior to our involvement. You can see that nobody controlled it. Each color there was a different owner. And that's, really, really problematic. This is what we own today. It's about 90 or 95 acres. And that gives us the ability to really put our mark on the site and change the environment and change the narrative and put in the high quality amenities that people want in a high quality environment. We've gotten a lot of support from the city of Dallas, including adding additional exits on 67 and financial investment. And the reason for that is that because the area still has a reputation as being, less desirable than North Dallas, the rents don't really match the investment that we wanted to make in it to make it really high quality. Our expectation is that the next investor won't need that, because we've already proven out the marketplace there. So we've been at this for 5 years. What have we accomplished? Well, the first thing we've accomplished is a lot of tenants. And what this has turned into is a full mixed-use development with a lot of medical facilities. We've got 200,000 square feet of medical facilities with Parkland and UT Southwestern and Children's Health. We've got a lot of employers there. Chime Solutions employs about 1,600 people. All of the medical facilities employ a lot of people. We've got a Dallas Entrepreneur Center and incubator space. We've got some higher education, Christian College. We have it's actually now not just a Courtyard by Marriott, but it's also a Courtyard and a Residence Inn that'll be beginning construction here in the next few months. We have the first Class A apartment building in the area that opened a couple of months ago and is already 100% leased. Starbucks, and we've now got several other restaurants that we'll be announcing shortly. So we've really turned the corner in terms of proving out the viability, and now we are, continuing to do that. And I think it's having an impact on the surrounding area. A lot of the apartment owners have invested millions of dollars in upgrading their apartments, and it's also helped the single-family market, because a beautiful house on a beautiful lot is great, but it doesn't really help if people want to work near where they live. They want to be able to get a cup of coffee in the morning. They want to be able to go out with their spouses for dinner. And we're bringing all of those amenities to the area that makes it a much, much more attractive place to live. So this is what the site looked like before. And this is the vision of what it will look like ultimately. And what I can tell you is that there's nothing on this page that isn't real. This is Camp Wisdom Road. We have already built this. It's a 20,000 square foot Foot Locker. We are in the process of building this 1 acre green space. And we're working leases for these two buildings, which will be restaurants. This is the Starbucks that's built. This is a building we renovated that is occupied now by Frost Bank, a dental office, a breakfast spot, and a Fuzzy's Tacos. This is the apartment building that I mentioned before. This is the Marriott Courtyard that'll be going up. UT Southwestern is over here. Parkland is in the back. Chime is on the second floor of the mall. So this is all happening. We will be finishing our site work by the end of the year. The entire site will be concrete, well landscaped, well lit, pavers. You know, we want it to look very, very high end because that is what that's what folks in the community want. This is another view of it so that you can see it in site plan form. Just to orient you now, Camp Wisdom's at the top. Here's the lawn, the restaurants I mentioned, UT Southwestern, the apartment building, the hotel. So you can see that we've got a lot of amenities, and the interior is remaining retail. The second floor of the mall will be office, but the first floor of the mall will remain retail and family-oriented entertainment. And I'm just going to end you with this image. I told you that the Starbucks was the #3 Starbucks in the city. This is their drive-through line. It was during COVID, so it was closed. So the actual restaurant was closed. But you can see that there's no lack of demand for the amenities that we've got. And you can also see, hopefully, that this is a very, very attractive brick, steel and glass building. Everything we're doing is very upscale because we're trying to attract people to the area, and we're trying to serve people who are in the area in the way that they would like to be served. So that's my prepared presentation. I'd be more than happy to take any questions that you might have.
Thank you so much, Peter. And everyone, please help me thank Peter. Peter, this is such great and exciting information for the South Dallas RedBird revitalization project. We're really excited. But we do have some questions, actually a lot of excitement, and I'd like to kind of share some of it. One of the things, this is so encouraging for the southern sector, such a beautiful part of our community. Another person said this is a very well planned and executed redevelopment, so needed and excited for the DFW area. Another question, are there grocery stores in the area?
So grocery is the big issue. The answer is that yes, there are grocery stores in the area. This is really not a part of town that I would characterize as a food desert, and mostly because it is immediately proximate to Duncanville. And Duncanville does have a Tom Thumb. And so there is grocery. The problem is that it's not as high quality as folks want. It's an old Tom Thumb. There's some Aldi's in the area. That's not exactly the high-end look that everyone is going for. So we are working very hard, and we're partnering with the city of Dallas to try to attract grocery. I think that the area has such an undeserved negative reputation that grocers are reluctant. And they worry that they're going to have to spend too much on security, that there's going to be theft, all sorts of issues. And so we've just not been able to attract a grocer yet, but we will, because as the apartment building has filled up, we probably will do a second phase of residential. Eventually nature will take its course and the market will cry out for one. But at the moment, I would say the closest really high quality grocer is the Sprouts in Cedar Hill. Okay. And it's a 10-minute drive. It's not terrible, but it's not what it needs to be.
Okay. Another person asked, when will the project be completed?
Well, it depends on what you mean by the word completed. The first phase, and Ann Bingham, I agree, we need a Trader Joe's. Believe me, that's on the agenda. the project, the first phase of the project will really be completed mid 2022. The site work will all be done by the end of this year. UT Southwestern will be occupying and open by mid 2022. And most of the exterior renovations of the mall itself will be complete by then. There'll just be one building left to renovate. But this is a development that can go on for years and years and years. It's over 90 acres. And right now, the rents don't justify vertical construction. And so we're using a lot of parking field. As that changes and we can justify structured parking, there's an opportunity to put a lot more density into the area. As it is, even with the parking that we're reserving, the area that we're reserving for parking, we still have about 20 acres of developable parcels. And so I think that this could be still going on 15 years from now in terms of adding to it. But it's, I look at it kind of like victory. The arena was finished in 1999 or 2000. And so that was phase one, but there's still new things happening there 20 years later.
Right. Another person asked, besides grocer, what other types of tenants are they searching for?
So we're pretty heavily searching for restaurants, and we've gotten quite a few, but we'd like a couple more. There's a real lack of sit-down, non-fast food restaurant in the area. So we're looking for that. We're looking for office tenants. We are very, very much trying to fill up the old anchor buildings with office tenants because, people, I think the statistic is that 95% of the leasable office space in the city of Dallas is in North Dallas, 5% in Southern Dallas. Well, it's really hard. It's harder and longer to get to work when you can't live near where you work. And if you want to live in that area, which a lot of people do, we need more office space. So that's one thing. And then I saw pop up on the chat a question about retail. Yes, there is going to continue to be retail, and we are retaining the first floor of the mall to be retail. It'll be about 150,000 square feet of retail, and we do have a lot of retailers in there, but they're not of the quality that we want. I think that interior retail will be the last thing that happens because malls are not in vogue right now to begin with. Retail is really hurting. The 1-2 punch of COVID and Amazon, and then COVID, exacerbated the problem with Amazon. Retailers are not exactly dying to expand. And if they do want to expand, they're generally trying to go to outdoor centers. But once we have this built-in audience of 2,500 or 3,000 people coming to the site every day to either go to work or go to the doctor, we think the retail will come. And we are beginning to have those conversations with, the name brand national retailers that folks want.
Thank you so much, Peter. Again, we appreciate your time, and I'd like to introduce our next speaker.
All right, thank you very much.
Absolutely, thank you. I'm excited to introduce to you John Stevenson. John brings over a decade of experience as an owner's project manager or professional engineer for numerous universities, airports, urban districts, manufacturing facilities, healthcare districts, museums, office and residential buildings, cultural centers, tribal facilities, FAA and TxDOT, specification private runways, nonprofit organizations, research campuses, station power plants, and private residents. He possesses skills for soliciting, qualifying, selecting, and leading multidisciplinary teams across countries, companies, and offices. John has been involved in a number of successful projects just to name a few: the Amon Carter Museum, Sundance Square Urban Redevelopment, Texas Trust CU Theater at Grand Prairie, Royalty Row Urban Redevelopment in Irving, and the Fort Worth Youth Orchestra. Lastly, a project that is very near and dear to our hearts, MetroTex Association new headquarters. Mr. Stevenson earned his MBA at the University of Texas in Austin and a BSNE degree at Bucknell University. Thank you, John, and we now welcome you. So thank you so much.
Thank you so much, Marion, for that gracious introduction. Let's see if I can share my screen properly without crashing everything. Hopefully that worked. Again, thank you very much to the MetroTex organization for inviting me to be part of Forecast 2022. I'm truly honored to be speaking with such prestigious presenters, and I'm sincerely thankful for the opportunity. The goal of this presentation is to talk a bit about what happened in the construction market in 2021 and to see what might be in store for 2022. In a bit of foreshadowing of what I think 2022 will look like and an overt commentary on my love of Tom Petty, this discussion is called Damn the Torpedoes, Construction in 2022. Here's an outline of this conversation: an introduction of my perspectives, what happened in 2021, what might happen in 2022, what to do with this information, sources and references, and an opportunity for questions. So first, a quick introduction from where my perspectives come. As Marion noted, I'm with a company called the Projects Group. We are an owner's representative. In fact, we are your owner's representative on the MetroTex headquarters project, which I'm thrilled to say is moving along very well. I look forward to all of us sitting together in the large banquet room for Forecast 2023. On that note, I thought it would be fun to show y'all a clip of where the project stood as of last week, and we'll see if I can get this to play properly. Well, I hope that came across all right, but as you can see, we're starting to go vertical. We have the bridge crossing onto Kin West complete, and we're really chugging right along. It's going very well. Why I think it's important to mention what we do is because it means our job is to understand the construction market, understand what's coming, to enable your real estate project to be successful while you, the owner, do your day job. Essentially, you hire us to build and manage the team to deliver your vision in the built environment. And this is the approach I took to this presentation, looking at the factors in the built environment industry that give me pause with my clients right now. One of the things I love about MetroTex is that the organization draws folks from all sides of the real estate space. My hope is that the feedback and perspectives in this presentation will help you, your clients, or other folks in your circle, even if you aren't a developer or builder yourself. Now, what happened in 2021? First, we'll touch on demand. As you've already heard from Dr. Gaines, there are many metrics that can provide a level of quantitative perspective of what happened in the construction market in 2021. The year-over-year starts were up, but that was largely because they were so handily down in 2020. The bulk of this rebound was in new home construction, with non-residential construction actually falling year over year relative to 2020. But what were some of the causes of these metrics? Surely those in the top section had an effect, but what were some of the other qualitative factors that led to it? First, permit delays. Going into 2021, one of the largest yet quietest issues facing the building sector was the permitting process. Now, I'm not saying this was the #1 cause of issues in construction in 2021, but it was a problem that existed before anything else occurred in 2021 because it was a carryover from 2020. There are a few headlines here that reference the issues faced in Dallas, but Dallas was not unique in experiencing this problem. The pivot to work from home in 2020 was not something for which many authorities having jurisdiction or cities were prepared. This led to a lack of communication between departments, information being dropped, and processes that center on paper just being left behind. Also, with the surge in home building, the permit offices were slowed down by the additional handholding required by those types of projects, compounding the issue. This added thousands and thousands of dollars to new projects, due in large part to the bigger industry effector in 2021, materials supply and pricing. First, we'll touch on materials supply. I'm sure lots of us saw this meme and felt like we were living it, but like so much good sarcasm, it was rooted in reality. Lumber was incredibly expensive for much of the last year. We've touched on the growing residential demand, the building sector that primarily uses wood framing, but that really wasn't the only cause of this increase. As climate change continues to show itself, fires have grown in their frequency and devastation. Lumber supplies are used up by project demand and by fire, driving up the cost of new projects. But the opposite side of climate change also showed itself this year. Winter Storm Uri brought incredible damage to our area, and I think I speak for all of us when I say we don't need any more snow for a bit in North Texas. This storm generated billions in repairs, which put even greater stress on the construction system here, which was already booming and struggling to keep up with demand. Obviously, there was a lot of unexpected building demand generated by storm repairs, but it's also important to remember that while you and I might have been without hot water for a bit or had a plumbing leak, those same issues happened at an even larger scale for materials production facilities. One of the largest plastics facilities in the US was disabled by the storm and is still working to get online. While hurricanes are a relatively common occurrence on the Texas Gulf Coast, such significant freeze events are not. If the plants don't have enough time to properly shut down, which they didn't in this case, the polymers can freeze and gel within the piping, leading to significant damage. And plastics are all over construction these days. Roofing, insulation, piping, these materials are now major delays, and these delays have really developed just over the last month. This is because many of these production facilities aimed to sell their product stock while they made repairs, but those repairs, because of the issues in the construction industry, are going slowly. The stock these plants had before Uri is dwindling before production can resume to replace that stock, leading to major crunches in domestically produced plastics. But not all material is refined here. After all, if you're making steel or a copper pipe or any number of other things, those materials come from select places in the country or world that have to be imported to where they're needed. This is a photo from last month at the Port of LA. Dozens and dozens of container ships just waiting for the opportunity to dock and unload. And when they do, a traffic jam awaits them that makes the Metroplex's traffic maelstrom look like a Hot Wheels game. What's one industry that's been hit hard by underemployment and difficulty finding labor since even before COVID? Trucking. The ability to get material and get it to the job site caused significant disruption to the construction marketplace. And this was shown in the next section. Materials costs. Here's the reality caused by those material lead times. For the same quality, you'll have to pay more. Take a look at these regional cost escalation percent changes by quarter. Significant quarter by quarter cost increases in every area. Thankfully, the DFW area isn't seeing quite the same peaks as the other areas, Yet another reason to be glad we aren't LA. But keep in mind that materials and contractors can move around a good bit. So just about every region is feeling it similarly. What do these movements and inflationary costs look like on a material by material basis? Study the materials here. It's the ones you've heard about in the news like wood and steel, but it's also things that make your project cost more without making the news, like roofing and coatings and insulation. Again, these are plastics, going back to the conversation earlier about plants being offline. And even if you want to use wood framing, you could move to metal if it's more cost effective. There's an ability to change products in construction, which means an increase in one material can actually drive up cost in another category. But what do these movements mean when translated into raw material costs versus just percent change? Well, it looks like this. The example here is steel. As you can see, we've been seeing steel prices around $500 to $600 per ton prior to March 2020. In fact, there was a portion of time when steel prices went down right after COVID. But starting almost a year ago, in September 2020, steel prices began to really take off. How do these changes look beyond just steel? They look like this: a major jump in the input costs for residential construction. Keep in mind, right in March, April of 2020, we saw the input costs actually drop. And you saw that on the steel price per ton amount on that earlier slide. So the spike we saw on a percentage basis on the last slide is even more dramatic because of this dip that happened before the surge. We started off at a lower input cost value. Moving over to non-residential construction, the same surge is there, but what's particularly interesting about this graph is that it's showing the spread between input and output costs. When I spoke in the MetroTex commercial forum in June 2020, I mentioned that there was some sort of adjustment needed in the commercial construction space because of the large deltas between input and output costs. Essentially, heading into early 2020, contractors were seeing larger and larger profits because the rate at which output costs were rising was actually higher than the rate at which their input costs were going up. We'll discuss later why this gap changing is an important factor for how you approach 2022, but let's stay on the topic of bidding for just a second. What does the trajectory in this figure look like if you're looking at growth in input costs and bid costs? It looks like this. There's been a nearly 30% surge in input costs with a 5% growth in bid prices. The contractor is now having to pay more for materials than they committed to charge the client in the contract. What pays this massive gap? Well, in simple terms, the contractor's profit has to pay for this gap, depending on the contract format, so it may now be driving to zero profit on the job. Gotta love energy efficiency, my light turning off there, sorry about that. This means some firms may close. Others may just pray they can pass today's loss against additional profit in their next job. Again, the next project you're sending them might cost even more than the haircut they just took on the current project. So for now, remember that the surge in materials costs is affecting both residential and non-residential markets. But materials aren't the only factor in construction costs. What's the other part? Labor. As Dr. Gaines already noted, there have been some significant fluctuations in the labor market due to COVID. Here are the employee numbers for NAICS Code 23, which is construction. All industries saw a drop in employment for part of 2020, but what's critical for 2021 is to see that labor has not caught back up for construction. This large gap is causing major issues in the space. It's tough to find folks to do this hard work. It's even tougher to find skilled tradespeople for the work that requires specialization, which again increases overall costs and schedule to achieve the same level of quality. So let's start to get a little positive. What else happened in 2021? Impulse. Now, I'm still an engineer at heart. For those who aren't engineers, impulse is the force you apply to change momentum. And we're starting to see that over the last few months of 2021. We are seeing positive forces beginning to change the rather negative momentum I've just discussed. First, this is the Architectural Billings Index through August 2021. This is a great way to track what the next few years may look like because you won't be paying architects if you don't have a building project for them to design. Again, this is done relative to last year, and you can see we've got several months of positive design billings movement. This shows good things for demand in the future. Another great metric, in addition to tracking design billings, is to use the Dodge Momentum Index. This is a way to track projects when they are first mentioned in any form from a planning perspective. It can usually beat formal construction or design spending by at least a year. What is important to note here is just how the market is continuing to evolve and adjust, even on a month-to-month basis. If I'd been speaking with you just a month ago, I think we would have an even rosier outlook of the future than we do today. Now, that's not to say the outlook is bad, but look at how the skyrocketing confidence of the winter, spring, and early summer of 2021 ebbed back some in the last few months. This is due to all the issues we've already discussed: materials costs and lead times, labor shortages, and a resurgence of COVID-19. While things are looking better, it appears we might need just more impulse or force to get out of it. So, with that in mind from 2021, what might happen in 2022? First, demand. Let's go back to this graphic from Construct Connect's Q3 forecast. As you can see, there are projections of growth in nearly every category going into the next 4 years. Year-over-year growth in starts in all categories. At least on a percentage basis, relative to prior years, this looks very positive. But what do the builders think of these data? Well, for single-family construction, there's a pretty easy way to tell using the Housing Market Index. This is a metric from builders of what they think the next 6 months will hold for their industry. This table tracks both the HMI and new build starts going back until 1985. As you can see, there was a precipitous drop in both starts and HMI in March 2020 from COVID. But this rebounded in the later parts of 2020 and early parts of 2021. But then there was a large dip, starting just a few months ago, in confidence. This drop goes back to some of the issues we discussed in the 2021 section, but it's clear builders understand at least some of those struggles will stretch in some fashion into 2022. It also alludes to a key difference between the table on the last slide, which noted starts, and total construction volume. Here we see the entire construction volume going back for several years. This is where the effect of the delayed or reduced starts in 2020 and 2021 can be most readily seen on total construction volume. The projects that would be the foundation of spending in the next few years and next few months should have started last year, but didn't. That means construction spending will ebb and flatline some on this projection. It's worth noting that not all markets were affected by these delayed starts, however. Here we can see how each of the 3 core industries rebounded or didn't. The bulk of the return to the total construction spending amount was really just in the residential space. Non-residential and infrastructure civil spending aren't back to January 2020 levels and aren't expected to do so through 2022. MetroTex's membership is heavily invested in the residential and non-residential portions of this graph. I'm sure the residential brokers are thrilled to see the residential line keep rising, and I know the non-residential brokers are celebrating the blue line turning up at the January 2023 mark. That said, it's important to comment on how the third category, non-building infrastructure, could affect the other 2 categories later in 2022 and after. This graphic is from ING outlining the various spending categories in the $550 billion Infrastructure Investment and Jobs Act. This will have major effects in the construction space, leading to an estimated 7% per year increase in the overall industry for 5 years. Keep in mind, too, that this is still short of the $786 billion in infrastructure backlog from the American Society of Civil Engineers. So there's still more to come in hard infrastructure investment. As I've noted a few times, labor and materials are becoming increasingly interchangeable between industries and regions. So this heavy influx in the infrastructure segment will have effects in the other categories, residential and non-residential buildings. Also, before any of the implementation dollars can be spent, design teams will have to generate the necessary documents for those projects. This means the effects of the infrastructure bill, they are already starting. Now, on to material supply and cost. Since these are really projections of how cost and availability are connected, I combined these two categories versus treating them separately in the 2021 recap. First, let's go back to steel as the example we discussed for the 2021 situation regarding material cost. Here are the contract tonnage costs for contracts signed today with a delivery of material up to 15 months from now. As you can see, the cost dropped significantly during this period by around $500 a ton. This is a very positive trend. But remember where we were at the start of this, $500 to $600 per ton. Again, good progress in the next 15 months, but prices are still historically high relative to the past. Remember this figure from earlier when we discussed the large gap between input costs and bid prices? I commented that contractors will hope their next project will save the loss they're taking on their current projects. And they have precedent for that thinking. Look at the peaks of red and the valleys of white that follow them in this figure. I won't say the integral or the area under the curve of the red areas equals the integral of the white area that immediately follows it, but it sure looks very close. We'll be in this red area for the next few years, but there will be a large white area after this tumultuous red area to allow whatever construction firms still exist to catch up. So, what do we do with this information? The first phase, project development. First, and I cannot stress this enough, build your team early. Who is on the team is going to vary project to project, but I've listed out some of the team members who are almost definitely in the mix. Getting these folks engaged early builds camaraderie, integrates the various stakeholders, limits future confusion, and potentially saves you money in fees because you're creating a good backlog for these vendors. Getting a good owner's representative early in the project can help you in selecting and validating the need for these other stakeholders. This representative can be someone internal to your organization or someone external, similar to what the projects group does. For the second point, it's critical that if the project is intended to generate revenue, the owner team knows what the key indicators are to adjust during the project to change the outcome. Meaning, if the project is highly sensitive to construction costs, but it isn't as sensitive to when it opens, consider delaying investment in detailed design until some backlog has been removed from the marketplace. This is particularly key right now because you cannot just buy schedule like you can when supply chains are better. What this means is that historically, you could pay extra to expedite equipment or materials, and that's just not possible right now. It leads well into the third point, know your market. This means the industry in which you're building and the area in which you're doing it. Know your competitors, and those aren't necessarily your business competitors. Remember, the Facebooks, Googles, Amazons of the world, and those upcoming infrastructure projects, they are all buying more material and more labor than you are. They are also operating off of prototypes, meaning they know what they need far earlier in the planning stages than most other projects do. If you can, avoid markets where those competitors are or avoid the materials they use because they might lock up the supply chain before you even know what you need. And finally, in this phase, think about alternative delivery methods. Do you want to proceed with the conventional design bid build methodology, Or might a design build structure be more advantageous for your work? Work with your owner's representative to determine this, but there could be significant benefits to design build in this market, depending on the project. There are reasons why the volume delivered through this method has outpaced overall industry growth in the last few years, especially in Texas. But regardless of what delivery method you choose, think about breaking the project up into phases to give more time to firm up later scope options. Next, design. Assuming you did what I recommended during project development, the first bullet is already done, but because it's so important, I've reiterated it here. The builder can give you guidance about what the trends are that they're seeing, give you builder-specific feedback about their subcontractor market, which varies between builders, and they can also find ways to improve or optimize design to best align with how they would build it. It's also critical to consider ways right now to incentivize a team approach between the owner and the contractor. This means, while I'm not typically a proponent of it, now is a time to consider generous shared savings clauses in your prime agreements. Work with your builder for how cost escalation will be handled, because it will come up. Lock material price increases to market indices. Include an escalation clause. Directly procure the materials, or all of the above, depending on the material and the project. The point is, be asking these questions and thinking through the answers with the entire team. Next, be flexible and agile with cost optimization. The builder should give you feedback of how to optimize design, and also, come on, maybe that's a cue that I'm getting close on time. Give you real-time feedback of what, if any, release packages are needed for the early phases of the project. In today's market, these could include the typical standbys of elevators, steel, mechanical equipment, but it should also now include insulation and roofing because of what I talked about earlier. I noted previously permitting delays being a growing issue. We're also seeing increased regulation. Working with the permit expediter, noted as a team member on the last slide, and the authority having jurisdiction during design will avoid delays and surprises. Now, into delivery, the final stage. My first priority is always safety. We want everyone to leave the job site the same way they got there. That's very applicable now because a COVID-19 outbreak on your project site could lead to throwing the job even further off schedule. Here's the same point again, because it can still be done in this phase. Be flexible and agile with cost optimization. That means your construction and design teams need to both understand that not everything can be held sacred right now because of the volatility in the market. Expect delays and overruns. Depending on contract structure and timing, the contractor is likely at high risk of having pricing overruns cut into a profit. That disincentivizes a team approach. Contractors are going to be looking to make some of this back on current or future work, just as we discussed previously. In part of this, and the reduced availability of quality materials and skilled labor, ensure you're invested in frequent and experienced materials testing during your project to maintain the value and quality for which you've paid. There are good metrics for different regions for weather days to include in your construction schedule. I'd recommend adding a few extra on top of that due to increasing severity and frequency of extreme weather. At the end of the day, this also buys you more schedule contingency, which is critical. So, in conclusion, things are unique and complicated right now, but with enough planning and partnering, it's still a good time to build the future. Full speed ahead. I included many of the citations within the presentation for the various data sources, but these are entities that provided interviews or meetings with me while preparing for this presentation. I wanted to thank them all for their support. Now with that, I would love to take a few questions.
Awesome. Thank you so much, John. Let's all give John a round of applause. And we're going to start our questions phase. The first question is, do you see the infrastructure investment slowing down residential new builds due to restrictions in the supply chain?
100%. Again, the materials between the residential space and those infrastructure projects, perhaps on their surface, makes it seem like the two are not related, but they truly are. The labor is also another great example of how a laborer could move between both of those industries. And so that's going to continue to crunch that labor market. Also, the planning aspects of those large projects are very significant, and planning and entitlement survey, all of those things, you need that for any large subdivision that you might be setting up right now. So again, yes, I would say that those could affect it.
Okay, another question. Are you seeing expansions in modular residential home construction to lower costs?
I love this question. I love this question. Modular is truly the future of construction. And you're starting to see it take off more. It's really in hospitality. It's really in multifamily. I haven't seen it too much in single family residences, but 100% multifamily and hospitality, it is already taking off, and it is certainly lowering costs.
Okay, well, thanks again, Mr. Stevenson. It looks like we have finished the end of the Q&A. And again, thank you for your time. Great.
Thank you so much.
I'm excited to introduce our final speaker of the day, Mr. Steve Brown. Mr. Brown is a real estate editor of the Dallas Morning News. He has covered the local and national real estate market for the Morning News since 1980. Prior to that, he worked in the newspaper's metropolitan and Tarrant County sections. His area of coverage includes commercial and residential real estate, mortgages, finance, and design and construction. Steve is a Dallas native, attended Dallas Public Schools, and graduated with a degree in journalism from Southern Methodist University. Please help me welcome Dr. Brown. I just gave you a new title.
I'll take anything at this point. It's good to see all of y'all. Boy, haven't we been through it in the last year and a half. In over 40 years of doing this, I would have never predicted things that have happened to us in the last 18 months, 2 years. I'm beginning to think it's like one of those old Bible story movies where we've been through the floods and the fires and the plagues, and now I'm waiting for the asteroid to hit. But the shocking thing of it is that the real estate market through all of this has just excelled. When COVID hit early last year and we began to figure out just what we were in for, you may remember there were immediate projections that housing values were going to fall by 20%, that the apartment landlords were going to all go broke. I mean, the first blush that foreclosures were going to explode, the first blush was just real dire. And like Jim Gaines said, it shows that we're such uncharted territory that nobody had a clue really what they were talking about. They were just casting about. The fact of the matter is that the real estate market, as you guys all know, it has done better than it ever has. This call is emblematic of that. There was almost 600 people signed up for this call. You guys were oversubscribed with people wanting to be in on this call. And the latest numbers I just got from the NAR show that the number of real estate agents is at an all-time high. Again, that's when total employment has been falling. That's when people are out of work. The real estate industry has just been going crazy. Yes, the first month or two of COVID, when we went into lockdown and a lot of sales were delayed, things kind of slowed down for a minute there. But then the housing market in particular took off, and nobody has looked back since then. It's just gone up, up, and up. And now I'm going to attempt to use these slides, and we'll see if it works. There we go. Well, you guys may have to see my my side up to come slides too. Why things have done so well. It's jobs and it is people. We went down significantly during the start of the pandemic with lost jobs, but we've just about made them all up. The numbers we got from the feds earlier this week show we're about 30,000 jobs away from making it up where we were. So we've come back dramatically, And again, barring some other new killer infection that we're not prepared for, as Jim was mentioning, we should have all of our jobs made up by the end of the year, which is really, considering where we've been, that's an incredible thing. And people here are still hiring like crazy, even though we obviously still have big shortages of workers in the market. We're continuing to see real good hiring. These were the year-over-year numbers we just got as of August, and you can see how Dallas-Fort Worth compares with employment gains to some of the other big markets. We're number 3 behind LA and New York, but then they went down an awful lot further than we did. So we're in so much better shape. And I know everybody is just enamored with Austin, and I know Austin's a great place, but look how many more jobs we're creating, and Houston is creating, for that matter, than what's going on in Austin and San Antonio. So when you talk about where the work is, it's in Dallas-Fort Worth, and we expect that to continue for quite some time. Because of the employment market here, we've got so many folks moving here. This was a snapshot that came out from the census just last year that said the Dallas-Fort Worth area gained during COVID almost 75,000 people moving here, net migration. That's what's driving the housing market. It's all the people moving here needing someplace to live. Houston was number 2, Atlanta was Phoenix was number 1, Houston was number 3, and Atlanta right behind that. Look at the job losses or the migration out of major markets like New York, LA, Chicago. So we've got these thousands and thousands of people moving here. They all need someplace to live, and that's what's making the housing market crazy. The new census numbers that we got this summer showed the 10-year population gains for the big Texas counties. You can see it's amazing what Tarrant County has gained in terms of population. Dallas, not so much, but Tarrant County, Collin County have just been growing like crazy. All of Dallas-Fort Worth over 10 years gained a million and plus in population. That's the equivalent of everybody in the state of Montana moving here. And, thank God it wasn't Oklahoma. But we've seen such huge amounts of people moving into the area. That's what's driving the housing market. That's what's keeping the housing market just crazy. This shows some of the city gains over 10 years. Again, Fort Worth is just growing like crazy. The reason it is they have still so much affordable housing over there, new housing, compared to the Dallas area. Austin, obviously, you hear about, and even this is city of Dallas. We gained 100,000 new folks here. So, this is from the Census Bureau. This measures individual cities around the country that had the biggest percentage gains. And look, Frisco's right up there. McKinney is up there. Of course, you would expect some of the Central Texas markets, but we're continuing. And this was with the impact of the pandemic. We're still continuing to see huge influx of people and jobs here. So that's what your housing market. It's people. It's jobs. Where are they coming from? No surprise, they're coming from California, they're coming from Chicago, they're coming from New York. This is a measure I just got out of census data that shows over time the number of people leaving California and the number of people coming to Texas. And if you drive around town, I was sitting in a parking lot the other day and looked around me at license plates: Vermont, Illinois, Tennessee, South Carolina, California. So we're seeing this huge wave of folks moving here, and I think that's going to continue. That's what's going to keep the housing market so crazy. It's fueled construction here. Even with the downturns we saw during COVID, the Dallas-Fort Worth area has been one of the top places in the country for all types of construction. This is construction value total last year. Everything, houses, offices, retail, you name it, macro number. You can see we came down a little bit, but still, considering we're in the middle of a once a century plague, that's not a very big decline. Here we were at mid-year when we had construction starts, residential, commercial, everything of almost $15 billion of stuff here. Again, second only to New York, right ahead of Houston. So we're continuing to see a huge amount of construction. Most of those numbers are on the residential side, apartments and single family. Commercial has lagged a little bit, but still strong. Absolutely. The home building market, as folks have talked about, has we're building houses as fast as we in the 12 months ending June, Dallas-Fort Worth led the country in single family building starts. There's actually about 10,000 more under construction. We're at almost 60,000 houses in the construction pipeline. We could sell more than that. The builders, there's just no, for the first time in any cycle, we're not going to be able to build our way out of this housing shortage. In previous housing cycles, we've always just run out and built enough stuff. Well, that's just not going to happen this time. We have these supply chain issues. We have the labor issues. We don't have enough lots on the ground to handle the demand for new housing. In the last 6 months, I've written stories about thousands and thousands of new homes planned in communities in Salina, in Forney, in North Fort Worth. But most of those are not going to be on the market for another couple of years now. So short term and really going out further than that, I just don't see any ability in the construction sector to meet the demand for housing here. And this is the first time that you really can't see an end to the shortages in terms of home inventories. Yes, the inventories will probably get a little bit better, but as far as getting back to the days of a 6 months inventory of homes on the market, I don't see that happening anytime soon. As long as we've got so many thousands and thousands of people moving here, it's just not going to happen. In August, for the first time, we saw a decline in single-family home building permits in the Dallas-Fort Worth area, and it's like, why is that going on if there's so much demand for new housing? Well, as was said, the builders have already sold enough houses that they don't need to sell any. They're not going to finish all the houses they've sold already through the end of the year. So they have such huge backlogs that they don't really need to be starting any speculative housing. And then again, the other issue is that they can't get the materials they need to start housing. So building permits dipped down a little bit because they weren't running out and taking permits for homes that they knew they weren't going to be able to start in the final 3 months of the year. So that was kind of surprising. And we had not seen that at any point in the last 5 or 6 years to the magnitude it has been. Again, that's something to watch. Home prices, gosh, I mean, what can you say? This is the Case-Shiller numbers. These are the percent increases. And it was up in July almost 24%. Now, I like Case-Shiller because, as Jim mentioned, it's not impacted by the number of higher price or lower price houses that sell. What they do is they take values of specific houses in a data series and compare what that house sold for a year ago, 2 years ago, 5 years ago, and compute it. So if they say that home prices here in July were up 23.7% from July of 2020. That's a real deal. That's not some screwy math mix up in the home prices. Again, we have never seen anything like that. Everyone agrees that it can't go on forever, but forever ain't what it used to be. I mean, we're despite a lot of folks predicting that it's going to slow down the rate of increase. it's like, why? We don't have any inventory. We have thousands of people trying to buy a house. Why will it slow down? This is the Case-Shiller numbers around the country showing how we compare to other areas. They don't do Austin. Austin is not a big enough market for them to do. If Austin was on this list, it would be close to a 40% home price increase. It's craziness what's going on down there. But again, look at the price increases in all these major markets. Now, again, the issue with this is if you're a seller, it's great until you go to buy something. But the overriding issue is that people's incomes are just not growing that fast. And so far, the declines in the mortgage rates have cushioned the impact of a lot of these home price increases. And that's not going to last forever, particularly not if mortgage rates go up. About once or twice a year, we run a report that these folks do that say that, oh, the home prices in these markets are overvalued by this much. Well, I don't know. These things are very subjective. You know, I think last time I was at the store, I thought steak was overvalued. And the last time I bought a new car, I thought it was overvalued. You know, what's overvalued? This group out of Florida just put this data out claiming that homes here are 30 some odd percent overvalued. Again, that's based on what people make and historical prices and all that kind of stuff. I just got another one today from Fitch, which is a huge Wall Street rating company, and they've rethought it, and they think that Dallas is now probably only about 10% overvalued, and they don't think that's too bad anymore. You know, these folks for the last 5-6 years have been claiming that home prices are too high here, and yet home prices keep going up, 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 and up. Nobody is really paying any attention to it. What it takes to buy a house. Realtor.com just put these numbers out. Again, based on the drop in mortgage costs, share of people's household income to buy a house is lower now in Dallas-Fort Worth than it was in 2008 when mortgage rates were higher. So again, the mortgage rate declines have made housing, even at these crazy, crazy prices, more affordable for a lot of folks. When the mortgage rates start going up, it's not going to take a lot of up to change this dynamic. And when it does that, that's when we're going to see what the true measure of overvalue and things like that are, because as long as mortgage rates are around 3%, that's not an issue. You know, all of y'all that have been in this business for a long, long time, you know, when I bought my first house, it was at 10%, and I thought I got a hell of a bargain. And so now people are refinancing for a quarter of a percentage point. And it's like, what is going on? We're so interest rate sensitive right now that when interest rates start going up, initially it will cause people to run out and try to buy a bunch more stuff. But, you know, good luck with that, because there's nothing out there. We talked about rising prices, and Jim talked particularly about the number of $500,000 homes that are selling. I think the reason we're having so many $500,000 homes selling is that you've got so many of these out-of-town buyers coming here with huge chunks of cash. These are some numbers I got the other day about the average seller in these markets and how much money they're walking away from the closing table with. In San Jose, that they're walking away with $575,000 on average when they sell their house, and San Francisco over $400,000. So when they come to Dallas-Fort Worth with $400,000 or $500,000 in equity in their pocket from an old home sale, and they look at our median home price here of, you know, $350,000, they're just, you know, they're laughing all the way to the bank on that deal. Even in the Texas markets, sellers are still walking away with quite a bit of equity. But when you look at the out-of-town people coming here and how much money they're coming into this market with to spend on housing here, I think that's one of the reasons home sales have stayed so high, regardless of the price increases we have. And that's why the median price creep has gone up so much, because you've got these folks buying all these high-end properties. And I really don't expect that to stop at all. Someone mentioned earlier, and I'm seeing a wave of this, particularly so many young families have been priced out of home ownership with the price increases we've seen the last 5 years, that they're now wanting to rent housing. We've announced plans for several thousand rental home communities in Dallas-Fort Worth just in the last 6 months. I had one last week in one of the newest big residential communities up in McKinney, thousands and thousands of new houses up there for sale. And they've sold a block of their land up there to one of these rental home communities where people are going to go in there and, $2,500, $2,800, $3,000 a month, rent one of these rental houses. And it's growing and growing and growing. It's some companies that are specifically just building the rental houses and they're owning them themselves. And as was mentioned, some of the great big massive builders like Horton and Weekly and some of them are talking about building some of these communities and then flipping them out to investors. I don't know how to feel about that. As strained as the home construction market for sale is right now, you are, yes, taking capacity out of that sector and putting it in these rent houses. And you are taking land and lots that you could be using for owners and putting it into rental. On the other hand, you've got thousands of people that want to rent these houses. And for the builders, it's a no-brainer, because instead of dealing with every Tom, Dick, and Bill and Mary here that has got to qualify for a loan, and I want this color countertop and all, you build 600 houses in a subdivision, build them how you want without having to fuss over somebody mad because you hadn't got it done on time. And then you sell the whole thing in one big block to one of these big institutional investors. Even if your profit margin is down a little bit from individual sales, just your hassle margin in having to deal with individual buyers is so much less. So don't be surprised if the amount of this continues to ramp up. DFW is one of the fastest growing sector for single family build to rent homes in the country. We're going to see a lot more of that. Again, I have mixed feelings about it. I know that young families with kids cannot live in an 800 square foot apartment if they value their sanity. They've got to go somewhere else, and they need affordable quality rental housing. So I know there's a big demand for this. I think we're going to see a lot more of it. Investor home buys here are picking up. We still rate pretty small compared to some other markets in terms of the big institutional buyers. There's still lots of mom and pops buying here, but in terms of the big Wall Street companies that buy houses and blocks, Dallas-Fort Worth is still less than 1% of our home sales here, compared to some places like Phoenix, where it's almost 6%, and Atlanta 9%. So the big institutional buyers are buying a lot more. So far, they're not buying as much here. One thing, there's not as much to buy here. The flipping activity, which if y'all watch these TV shows and it shows everybody laughing and drinking champagne and getting rich on flipping houses. Well, I flipped a house here a few years ago when my mom passed away and I had to redo the house. It was the biggest pain in the ass of anything anybody that is flipping houses, whatever money they make on it, by God, they earn every dime of it, because it is not an easy job. Nevertheless, in the second quarter, we ranked third for flips. These are houses that basically somebody bought, fixed up, and sold within a year. And it was about 6% of transactions that these folks at Atom Data estimate. Now, that's different than the investor buys, where you're buying something, you're going to hold it for a rent house. This is somebody, yeah, they may sell it to an investor, but in most cases, they're selling it to an individual buyer, where they buy an old house that's fallen down, they fix it all up, shine it up, polish it, and then sell it to somebody. So we are seeing an awful lot more of that. But it's very, very hard right now, frankly, because of the inventory issues, and there's so much competition from the young millennial buyers out there. I'll talk about the apartment market real quick. Again, early in the downturn, there was a lot of speculation that the apartment market was going to suffer. Yes, we did see a lot of people unable to pay their rent with the pandemic, and but in talking to landlords and in looking at data, Dallas-Fort Worth had the smallest amount of that of probably any metro area in the country. Some of the big coastal markets, New York, LA, places like that, had big percentages of people not paying rent. Here, it was always very small, less than 5%, and has been pretty much cured since then. We are the top apartment building market in the country. We have more than 35,000 units under construction, and people say, oh my God, we're building so many apartments. Are we building too many apartments? No, we're not building enough, because if you look back to those census numbers, we had 75,000 people move here last year, and they've all got to have some place to live. And we damn sure don't have the home inventory on the market for them to all buy. So where are they going to live? They're going to live in apartments. And that's why apartment vacancies have fallen back below 5%. That's why apartment rents have just gone crazy. The latest number I had for September was overall apartment rents in the area up 15+%. Look at some of the rents that these are median rents now for a 2-bedroom apartment. Up in Plano, it's almost $1,900. McKinney, $1,700. Overall, it's right around $1,200 for the entire Dallas-Fort Worth area. Apartment rents have really gone crazy. Again, it's all the folks moving here. When people move here, particularly young people, they want an apartment to rent. They may end up being home buyers at some point, but when they relocate here in migration, they want an apartment to rent. Dallas-Fort Worth, for the 12 months in the first quarter, was the top apartment investment market in the country. Investors spent almost $10 billion buying apartments here for the year end in the first quarter. And if anything, it's gone up since then. Apartments are hot, hot, hot. Everybody from all over the planet, I get sales, European buyers, Asian buyers, East Coast, West Coast, want our apartments. Really strong demand. The other area that's really heated up lately are condo townhouse. In some cases, it's because those are more affordable product, particularly on the condo side. And a lot of folks that maybe would have wanted to buy an existing single family home and got priced out, they've gone into the condo market. Condo sales this year in Dallas-Fort Worth are up like 40 some odd percent. It is just remarkable, the increases we're having. And townhouse, particularly inside the urban area, is now the top new home construction market because of land use. Big demand for it. These are some numbers from the Texas Association of Realtors showing how condo and townhouse sales have done in Dallas-Fort Worth in the last year or so. And every month they have gone up. Again, it's an inventory issue. We could be selling a lot more if we could have it. I'll touch on just a couple of more commercial real estate areas before we wrap up. The office market is doing okay. It's not doing great. Why? Because 60% of people are working at home. And we were all supposed to come back to work at Labor Day. And then, oops, the pandemic had other ideas. And now the plan is first quarter. And if things keep going like they are, I think that's reasonable. Dallas and Austin are already the top places in the country for people back in the office, a little over 40 some odd percent. In a lot of places in California and on the East Coast, there's still 20% of people are working in the office. The rest of them are working at home. Some of them will never come back. One of the biggest accounting firms, PricewaterhouseCoopers, this morning announced to their 40,000 employees that you guys don't have to come back to the office ever. You may come in 2-3 times a month, but otherwise keep working at home. There was one little tickler in that, is that Pricewaterhouse said, if you're working out of the LA office and you decide to move to Omaha to save money on your housing, you're going to get an Omaha salary, because we're not going to keep paying you the prices, the wages we paid you in super high cost places if you decide to relocate to a low cost place. So that's a little fly in things there. We'll see how many people take it up. But I got to tell you, given what I see in LA right now, Omaha looks pretty damn good. So if I decide I'm going to relocate, maybe I do take a little bit of a bump down in salary, but I may not complain too much about it. So office construction, it has continued, but it's pretty weak. There are a bunch of new stuff planned. We'll see what happens after the first of the year when people go back to the office. The one commercial sector that has just been crazy, and we're all to blame, is warehouse and distribution building. All that stuff you bought in Amazon in the last year and a half, a lot of it that you did not need, it had to be stored somewhere before it got to your house. And it wasn't just Amazon, it was Wayfair, and it was Walmart, and it was Target, and it was everybody else. So we are building more warehouse space here than any place else on the planet. Every week I see permits for millions and millions more square feet of warehouse space. You drive down along I-20 or I-45 or up north of Fort Worth on 35W. It is amazing, these great big concrete behemoths they're putting up as far as that's going to continue, because again, the e-commerce business is so huge. But more than anything else, those 1.5 million people that moved here in the last 10 years from Montana, again, thank God they weren't from Oklahoma, the ones that came from Montana the last 10 years, they all need soap and toothpaste and hair dryers and barbecue grills, and you name it, they all need it. And we got to have places to store it, because the one thing the pandemic has taught us that we thought we were oh so smart with this just-in-time distribution, where we didn't want to have a bunch of stuff sitting in a warehouse. It was going to be just slim inventories. We proved that didn't work so well if there's any kind of a hiccup. So most consumer products firms have trashed that whole notion of meager inventories and just in time. And now they want a warehouse with enough toilet paper in it to last for the next 20 years. They're not taking any chances. We all better be thankful for that. So with that going on, the amount of warehouse construction we are going to see is huge. A couple of things to wrap up. I do think that barring any more major concerns with infection by early next year, things will be mostly back to normal. I do think it's a new normal. I believe that, all of us folks that for years came to work with the flu and the stomach bug and, oh, I'm so sick, but I'm at the office because I have to be at the office. I really think the days of that are going to be over, because we should have never been doing it in the first place. And if anything COVID has taught us, is we don't need to be at work making everybody we work with sick. So if you're sick, stay home, because you can work at home. And if you're a major employer, you make sure your workplace is healthy. So a lot of the workplaces we've had where everybody is jammed together so that, you know, it's like a perfume at a sorority party, where everybody is jammed up so tight that you can smell what somebody's eating for lunch. That's going to change. We're already seeing companies start to move their people further apart. That's going to happen. And there's going to be a lot more emphasis on wellness in the workplace, which is a good thing. If there's anything good coming out of this pandemic, then that's probably going to be the thing. But the office is not going away. It's not going to be the almighty God it once was, and more people are going to be working at home. But they're probably going to be working at home a couple of days a week, and the rest of the time they're going to be in the office. So this summer I was saying, oh, we should be done with this by now. I'll say now by January should be done with it, and let's all keep our fingers crossed. But you know, the housing market, even everybody says, oh, it's going to slow down. Well, it's slowing down from going 200 miles an hour to going 100 miles an hour. So just how the hell slow is that? If we're having price increases now of 24% and it slows down to 10% price increases, you know, I remember when 5% was a damn good year for home price increases. So the slowdown is relative. I think things will calm down a little bit, but in the foreseeable future here, I do not see any change in the viability and the velocity of the home market. So I'll answer any questions anybody wants.
Awesome. Thank you so much, Mr. Brown. We do have a few questions. The first one says, with the increase in home prices, what do you forecast in terms of taxes for 2022 and moving forward? Is there a cap on the increase?
No. Well, you know, we can cap the rate of taxation, but we're not capping the values, which are going up like crazy. So, you know, yes, we already have got our tax bill last year. You know, you have to lay down on the couch when you open it. I think we've only seen that. You know, it's going to be a huge thing. But you know, what are you going to do about it? There's really nothing. Some of the local jurisdictions in the last few weeks have talked about cutting their tax rates by meager amounts on homes. But all right, let's trim my tax rate by 2%, and then my value's up 25%. Hello. So, you know, I just don't think there's any way around that. I think that's something we're going to have to put up with. And, you know, everybody still says, oh, well, compared to other parts of the country, it's not so bad. It's not so bad. But for all of us that have been here for a while, yes, property taxes are a huge issue. Insurance costs are a huge issue. But has it slowed anybody down from buying houses? No. I mean, the demand is still white hot. So for the foreseeable future, we're going to have to deal with it. But no, I don't think it's going to slow the market down.
Awesome. Got another question. Condo and townhouses sales are also being driven by investors looking for rental properties, since single-family houses prices have increased so much and inventory is so low. I guess that's more of a statement. Do you have anything to add with that?
Yeah, they are. You know, I had a story in the paper this morning, and it broke yesterday, of one of the big uptown apartment buildings that had decided to convert to condo. And then after 90 days of doing it, said, oops, we're not going to do that. In a lot of the markets around the country, Atlanta, the Florida, places like that, we are seeing huge numbers of high-end rentals converting to condos. And with the demand for housing now, you would think we would have more of that. But the fact of the matter is the people that own these apartment properties, they're owning them for the rental income. They're owning them for the income stream. So yes, they can sell them all at once and they get a big profit, and they have a tax issue with that, obviously. But that's not what they want. If it's a pension fund or a family investor, they're wanting something that they can have income on for 5, 10, 20 years. So there's no motivation for them to convert these units. And again, with the construction constraints, it's real hard to build condominium right now. You need the same kind of zoning as apartments, and the apartment developers are fighting over every scrap of land that's left. So demand for condos is there, but we're just not seeing very much construction. Townhouse, that's another matter. You go in parts of East Dallas, North Dallas, West Dallas, huge amounts of townhouse construction, and I think that's going to continue.
Another question, I'm surprised that the builders themselves don't turn into large-scale landlords.
Some of them that have these build-to-rent companies are doing that, but most of them don't want to be landlords. Anybody that's been a landlord knows that it's a pretty thankless job in the middle of the night when the tenant calls and the air conditioner's broke or whatever. The builders, particularly the big public builders, they want that income from building houses and selling them. They don't want the income from running assets over time. So there's just not the motivation about the big builders to be long-term owners. There is a motivation for them to build these houses and sell them to investors. And I expect we're going to see a lot more of that.
Okay. Is that the one by Whole Foods on McKinney? The one?
Yeah, the one across the street. Yeah. And they had a fair amount of sales. They had several dozen sales. It's just they told me that they were expecting by the 1st of October to be a lot further along than they were. And when it didn't meet their game plan, they were 95% leased as an apartment. And they said, the heck with this. So everybody that had put up their deposits got their money back, but that showed that it's a hard thing to convert one of these big buildings.
Okay. Do you see the Surfside collapse being a chilling factor on the condo market?
No, not so much, because there were a lot of environmental issues with that. With the ocean salt and the moisture and that kind of thing that made that a big issue. Plus, when you get right down to it and look at it, compared to a lot of other parts of the country, particularly Florida, we have a lot of high-rise condos here, but compared to Florida, compared to Atlanta, compared to LA, we ain't got nothing. I mean, it's very little percentage high-rise condo. So No, I think that was a signal to everybody that you get your business together and make sure your properties are well maintained. But I'm not worried about it having a big impact here.
Okay. At what point do you think the landlords will convert more properties into condos to see an ease in the demand?
Yeah, like I said, I just don't see that happening very much. I really don't. Now, because of the type of land, if you look at the properties that are most viable to convert into condo, they're the newer, nicer units and apartment units. And those are the ones that are owned by the pension funds and the real estate investment trusts and all that. And they don't want to sell them. If they sell them, they're going to sell the whole damn thing in one block 10 years later to meet some plan of theirs. They don't want to sell them one by one. So I just don't think we're going to see that much of it here. We saw it, the last time we saw it in a big way was in the very, very late 70s, early 80s, when we had a lot of apartment conversion, but the price point was a heck of a lot lower then. And it was just a different time. I don't think we're going to see that much of it this time.
Okay, and this last question, I'm hoping Jim can correct me. Do the C, which I'm assuming stands for condo, and single family resales account for the owner who puts in a lot of money to increase the resale price a lot?
The studies that we get over and over again say, and you guys, this is y'all's business, y'all know, it's kitchens and bathrooms. The upgrades you can do to your kitchens and bathrooms, that's where people get their money back. And that's where the upgrades are. Before we went into this hyper market we're in, people were so picky about condition. Y'all remember when they were going through houses with a microscope, hunting any little bug, any little thing and then we got into the situation we're in now where everybody's fighting over houses. And people are buying stuff online without ever setting foot in it. And condition was not the big bugaboo that it was 5, 6, 7 years ago. It's still an issue, though. and it's kitchens and bathrooms. The money people spend to upgrade those, even if you don't get a higher price, which you probably will, you're going to sell your house faster, because when somebody walks in there and they see it don't look like Granny's kitchen anymore, then they I want that house. That's the house I want. So that's the payback. And all the studies that are done by the rating companies and things like that show that that's where you get your money back. Yeah, you get some back for a swimming pool if people want a swimming pool, and there are other things you can do, but really that's where you spend your money if you want your money back.
Okay. A lot of late 70s, early 80s conversions were probably foreclosed properties, is a comment. Do you agree?
There were some foreclosed properties. A lot of them were small owners too, where somebody owned, a one apartment house or two or three, and there were companies that went around them that just made a business of buying 50, 100 unit apartments and converting them and selling them. The owner that had it didn't do it. The company bought it and did it. There were some Canadian firms. There were some companies from California and Florida that did that. Again, it was a different time. I just don't think we're there right now.
Okay. Are you seeing a lot of the commercial buildings that were struggling to survive because of the work from home? Are you seeing a lot of them converting into apartments?
Most of the downtown buildings have already been converted. There are a couple that they're talking about converting parts of the building to residential and keeping the rest of it office. We'll see how that works out. I don't know that office workers and apartment renters want to be fighting over the same parking places and elevators and everything else, but there's some talk about that. But I think we in downtown, particularly in the last 10, 15 years, almost every old tired building got a facelift and was made into loft apartments. And the last one just opened, the First National Bank building, 50 some odd floors with apartments in the Thompson Hotel, and is gorgeous. And that building had sat empty for 10 years or more. But it was about the last big, ugly, empty building left. And it's got done. So there aren't a lot left that fall into the category that you would convert into housing.
Awesome. Well, thank you so much, Mr. Brown. We appreciate you always. Thanks again. Thank you all for attending Forecast 2020. Our speakers have shared some amazing information, and we will make sure that you get a copy of all of their slides during the presentation. We also have taped this webinar, and it will be available on MetroTex YouTube channel sometime early next week. And by the way, MetroTex committee signups are starting, and we want you to go out to the website and join some of those committees. Committee sign up will go through the end of November, November 13th. We thank you so much and have a wonderful day. And thank you for attending Forecast 2020.